During our stock analysis, we're going to explore the key pillars, examine the ownership, look back at past results. We'll find out what the analyst predictions are, as well as giving the business a valuation, and examine the potential return on our investment, and finally we will summarise our findings. Let's start by looking at the key pillars for the trailing 12 months. In the book Rule 1 by Phil Town, he suggests that these are the key metrics when first evaluating a business. The first pillar we are going to explore is the earnings per share. This is where we take the net income and divide it by the shares outstanding. The higher the number, the more profitable the company.
Earnings per growth is up by 11%.
Now let's look at the free cash flow, which is the money a business can generate from its operations.
And free cash flow growth is down by 3%.
Then we come to the next pillar, which is revenue, and this tells us how good the company is at generating income before deducting expenses.
And revenue is up by 7%.
Book value is calculated by subtracting the total liabilities from the total assets, and this indicates the equity growth for the company.
And book value growth is up by a terrific 19%.
Now we want to turn our attention to the management of the business by looking at the return on invested capital and the return on equity. These two measures allow us to assess a company's efficiency at allocating capital under its control.
Return on invested capital and return on equity are 19% and 23%.
Now we move on to debt, and Phil Town prefers a company that is able to pay off debt with their free cash flow within 3 years.
Using their current free cash flow, they could pay off the debt in a couple of months.
In this next section, we will now focus on other key metrics which will help define an excellent business. Now let's look at the gross margin, which is the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides.
Gross margin is 46%.
Next we come to the operating profit margin. This tells us how much profit a company makes on $1 of sales after paying for costs of production, such as wages and raw materials, but before paying any interest or tax.
Operating profit margin is 38%.
For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability. He typically looks for a company that has a free cash flow yield of 5% or higher.
Free cash flow yield is a little lower than we'd like at 1.62%.
As we are potential shareholders, we will now want to look at the average book value growth for the last 10 years.
And this is 26%.
Ben Miller believes earnings growth is the biggest indicator to a company's stock price.
And the earnings growth on average for the last 5 years is 19%.
I've included a link if you want to check out the investors page and see the annual report. This is Bitesize Investments, giving you a step-by-step approach to your investment journey.
There are currently 3 super investors who own this company, and between them they have invested $94.7 million in Copart in Q1 of 2024. If we look back at AKO Capital's previous sales and purchases, we can see they have both bought and sold shares in Copart in the last few years and have increased their stake in Q1 of 24 by 32%. They have $152 million invested in Copart, and this makes up 2.26% of their overall portfolio. However, 6 other super investors have sold shares totaling $132 million in Q1 of 2024. Ray Dalio has previously bought Copart shares, but in Q1 of 2024 he sold 122,000 shares. He sold 91.4% of his shares and has only $623,000 remaining in this company.
Now we look at the past historical prices of the company, as this will help us build a picture of periods of success or failure the business has been through.
We can see that from 2014, Copart have steadily grown year on year up until 2022 when the whole market dipped, but now have recovered and have continued to grow.
On average, the analysts believe that the price target should be $51, but the analysts also believe that it won't go much higher than $52. Analyst reports suggest that Copart is a little undervalued at the moment, and the overall consensus is that Copart is a hold. Collectively, the analysts believe the company will grow between 4 and 15% over the next few years. So I'll use the current earnings per share of 1.42 as my starting point when creating a valuation, based on a combination of past growth, future analyst predictions, and the average book value for the past 10 years. I'm going to estimate the earnings per share growth to be about 18%. I'm then going to give Copart a PE of 36, and after that I'm going to project these numbers forward by 10 years. We then need to include a 15% return, and this gives me an estimated future stock price of $268 per share for its future share price. And then we work out the current value that Fieldtown calls the sticker price, which is about $66. And then we apply a margin of safety of 25%, and it makes me a buy price of $50. If you found this video useful, click on the link to check out my last stock analysis. The return we would receive if we bought at our margin of safety price of $50 and sold in 10 years' time at our estimated future stock price of $268 would be 436%, but this is only dependent on our assumptions for the company being correct. Currently, Copart don't provide a dividend. Let's find out more about the company and its competition. According to Morningstar, Copart have a wide economic moat. It is believed they have minimal direct competition because they have a broad network, robust service, and an online platform that has been developed since 2003. All these factors have given the company a significant advantage over its competitors. As Copart receives most of its vehicle volume through contracts with large auto insurers, it provides them with high operating profit margins. Now let's look at the bear case. Copart is vulnerable to any potential economic downturns or recessions as demand will decrease. Copart's stock price has seen significant growth over the last decade and may make it vulnerable to market corrections. In addition, they are dependent on the insurance industry, and any adverse changes in these relationships would affect the company's revenue. If you've enjoyed the video, it would be greatly appreciated if you would like and subscribe to help the channel grow. And finally now we'll summarise what we found out about the company. When reviewing the key pillars, Copart scored 10 out of 12. On under ownership, 3 super investors have bought in the last few quarters and 6 have sold shares. Their average share price is in an upward trend, and analysts are indicating that Copart is a hold, and they are predicting they will grow between 5 and 15%. Using the earnings per share growth model, my personal buy price will be $44 or less. If you click on the link above, you can find out more about my personal portfolio. According to Morningstar, Copart have a wide moat, and my final overall rating is 3.5 stars out of 6, and I've given this a category A rating within my own stock watch list. Thank you for joining me during this stock analysis video. As I'm a relatively new channel, please consider using the comment section to help me develop the content I am creating. And don't forget to like and subscribe.